Hello, my name is Lisa, nice to meet you. I'm with Little Touches Real Estate. And today, I'm here to talk to you about our capital partner programs. Our capital partners help fund our projects to get a return on their money. Without our capital partners, we would be unable to accomplish so much. Partners are either private lenders or equity partners. We'll explain them later. Today, we'll cover real estate market opportunities, private lenders and equity partners, sources of private capital, and how the program works and how to join. Now, about our team. We are a real estate holding company in High Point, North Carolina. We specialize in fixing, selling, and renting properties. We also manage residential and commercial property. Our team is the heart and soul of what we do. Our project managers keep us on task. Our property managers lease and maintain our rentals. Our associate realtors help us buy and sell properties. Our contractors bring our vision to life. And our capital partners fund our projects and make money with us. What type of projects do we get into? Distressed and unwanted properties, value-add properties, commercial and business properties, multifamily, mixed use, and more. Real estate. Opportunity for the future. Does the daily gloom and doom in the news scare you? It shouldn't. The market is always changing, but generally trends towards the positive. There is great potential in projects like self-storage, mobile homes and mobile home communities, multifamily and mixed-use upfitting, as well as flipping and renting property and more. And the data backs up the positive trend. This shows the potential growth of household wealth, based only on the increase in home values. And this graph shows rent trends since the 40s. Notice the steady increase despite recessions? Now, let's read what some of the experts have said.
The bottom line: investing in real estate is smart because property is tangible. People always have, and always will, need shelter. This means it is very unlikely that our need for shelter, in other words, buying or renting homes, will ever go away.
Buying real estate is not only the best way, the quickest way, the safest way, but the only way to become wealthy.
Real estate investing, even on a very small scale, remains a tried and true means of building an individual's cash flow and wealth.
For more quotes and other content, please follow our social media, or visit our website.
Thanks for your time. When this video is done, please visit our website, littletouchesre.com. Stay tuned for more. Don't forget to like and subscribe, as well as follow our other social media.
What are the types of partners, and how do they make money? First, there are private lenders. Basically, they become our bank and lend us money for projects. We will then pay regular interest and return the principal at the end. As security, you get a promissory note or lien on the property. Or, you could become an equity partner. This is when you exchange capital, or money, for an interest, or equity, in a project. Dividends are based on performance. Gains are paid when the asset is sold. They are arranged with a joint venture agreement or a business structure. Now, let's learn about private lending. What types of loans are available? First, gap loans. These loans are meant to cover the funds needed to begin a project until when the funds from the construction loan, or rehab holdback, become available. Or in other words, to bridge the gap. Next, project loans. These are loans from a single lender which are meant to fund the entire project, including purchase, construction, and holding. Finally, lines of credit. A lender with an available pool of capital to loan out will grant us a reserved amount as a credit line, which is available for us to draw and use as needed for projects at our discretion. What are the features of private loans? Usually the monthly payments are interest only. They have shorter terms, from 4 months to a year, and are paid off at exit. They usually feature a balloon payment and no prepayment penalty. The interest rates and terms are negotiable. The lender gets a promissory note, or a first or second lien, on the property for security. This type of lending is based more upon personal relationships than qualifying for a bank loan. The lender is responsible for vetting the borrower and performing their own due diligence on the project. There is also less paperwork and administration depending upon the lender. Can you show me some examples of how these loans work?
Certainly. First, let's look at a $50,000 gap loan. At 10%, the monthly payments would be $416.67. If the project were done in 6 months, the total interest paid would be $2,500, and the $50,000 would be returned at closing. Similarly, a $200,000 project loan at 10% would have monthly payments of $1,666.67. If this project wraps up in 12 months, then the total of the interest payments would be $20,000, with the principal being returned at closing. There are several advantages for both the lender and the borrower. In the lender's case, receiving loan payments means a steady and predictable income. The fees and rates you can charge may be higher than conventional loans. You have more choice over which projects you might fund. The loan is protected by a promissory note or lien, so if the borrower defaults, you can sue or foreclose. If you have a self-directed IRA, you can use those funds to lend for a potentially higher return and tax advantages. For the borrower, there are significantly less administrative requirements. These types of loans are more accessible to persons with credit challenges. Lending is relationship-based. The costs are lower than comparable hard money loans, and terms are flexible and always negotiable. There is a lot to think about. Now, let's go see how an equity partnership works.
Welcome to our Equity Partners orientation. Let's review. Equity partners contribute capital in return for dividends and gains based upon the performance of a project or property. Here are some characteristics of a capital partnership. These deals are usually for longer terms. They are usually used in larger, more complex, and better quality projects such as value-add, multifamily housing and others. It may be used in combination with lending for more diverse deals. Any dividends or gains paid are based upon the performance of the asset. For that reason, there is a potential for greater earnings. There can be multiple partners on one deal. You do your own due diligence on the project, so you don't have to rely on others' opinions. The partnership is established with a joint venture agreement or a formal business entity, such as an LLC or LLP. Now, let's examine an example of a deal. We are seeking to purchase a small apartment complex of 50 units that need value-add upgrades. It is currently fully leased and the monthly rent is $500 per month per unit. The owner is selling the complex for $700,000 and there are $300,000 in repairs needed. This makes the total amount of funds we need to raise be $1 million. We are approved for a $500,000 bank loan, and an equity partner funds the rest through a joint venture agreement for 50% of the deal. The plan is to take 5 years. At the beginning of the project, total rental income is $25,000 a month. If operating expenses are 40%, then the quarterly net operating income, or 3 months times total rent minus 40%, is $45,000. This would mean that the equity partner's quarterly dividend would be half of the NOI, or $22,500, or an annual return of 18%. As the project goes on, over the next 5 years, the repairs and upgrades are made. The management is replaced. The upgraded units are leased at the new rent of $800 per month. Meanwhile, dividends are still being paid. After 5 years, when the project is complete, total rental income is now $40,000 per month. Operating expenses are still 40%, but the new net operating income is now $72,000 per quarter. So now, the partner's dividend payment has grown to $36,000 per quarter, or a 28.8% annual return. But wait, there's more. Now that the asset is stabilized, with increased rents, and at a cap rate of 10%, the property, which we bought for $700,000, is now worth $2.88 million. After this, we put it on the market and sell it for $2.5 million. At the closing, the $500,000 loan is paid off. The equity partner has returned their initial $500,000. If we assume the closing costs to be about 10%, then that leaves $1.35 million as the gross gain from the project. So the equity partner's share, before taxes, is $675,000, for an overall return of 135%. Would you like that kind of return?
Thanks for watching. Did you know you can visit our catbuyshouses.com and submit your unwanted property for an offer? Don't forget to like and subscribe, and stay tuned for the rest.
I want to put money into real estate deals, but where do I get it?
That's a good question. There are lots of different options, most of which you may not realize and don't need to be wealthy to use. Let's look at some now. Funds in a self-directed IRA or a solo 401k. Some retirement plans allow you to use or borrow money in ways that give you access to the funds. Talk to your advisor to learn about these. Low-performance bank accounts. Do you have money sitting in a low-interest checking or savings account? Savings bonds or certificates of deposit. These are typically low-yield vehicles. Non-qualified brokerage accounts. Or, non-retirement stock, bond, or mutual fund accounts. Trusts. Are you a trustee that needs an income source or a safer vehicle for the funds you oversee? An inheritance or other windfall amount. Did a relative leave you a sum of money, property to sell, or did you have a banner trip to Vegas? Profit from the sale of an asset or item. Did you sell a collectible, or some land you held onto for a while? Gifts and bonuses. Did you get a Christmas or sales bonus at work? Old retirement plans. Did you leave an old 401k at a previous job? Again, talk to your advisor about how to make this work for you. Investment clubs. Are you a member of a group whose purpose is to grow a portfolio and get a return, usually for fun, or to benefit its members? Insurance. Some people have insurance that allows them to take loans.
Well, I wonder if I could refinance my house and use that money.
Actually, you can't. Loan proceeds, such as a home equity line or cash refinance, may not be used to fund any project.
Wow, there are a lot of options. I think I'll check my portfolio to see what I have available.
Awesome. You do that, and make sure you talk to your financial advisor to make sure this is a good fit with your goals.
So, what are the requirements that have to be met to become a capital partner?
A capital partner can be an individual or group, such as an investment club or business. But if it is a group, at least one representative must meet these requirements. They must read and sign the capital partner agreement. They must be 21 years of age or older. They must complete a suitability form. They must possess a valid social security number, or tax ID number, for individuals, or an employer identification number, for groups or businesses. Funds used must be in United States currency and, as mentioned before, cannot be borrowed.
Hello. What are the qualities of a good teammate or partner? They want to be involved in real estate, but do not want to be a landlord, rehabber, or agent. They want to diversify their portfolios by adding real estate. They want to help the community and improve the housing situation. They are trustees with assets to grow or the need to generate an income. They are retirees seeking to continue growing their nest egg or create a new stream of income. They include individuals, clubs, and groups with growth in mind. They want more control over how and where their money is used. They understand, while nothing is guaranteed, real estate offers the potential for more consistent and better growth. Finally, they don't need to have a background in real estate or finance since we will be there to guide them every step of the way.
As a capital partner, you will have access to many resources, such as a capital partner-specific area of our website with an inventory of potential deals, amongst other items. Access to our team and your own personal representative for questions, concerns, or whatever your need. Regular social media updates and mentions. Marketing and networking opportunities with our team. Website and blog mentions and backlinks. Podcasts and other media appearances.
If you like what you've heard so far, and are interested in finding out more about becoming a capital partner, then stop and give us a call. Visit our website and submit an interest form. Come by our offices, or send us a text, message, or email.
Once you complete the interest form and we review it, a member of our team will meet with you to explain the program, answer any questions, and complete the necessary paperwork. Remember, you don't have to choose any projects or commit any funds at this point. Once all your questions are answered, and if you decide to enroll, our representative will help you complete the enrollment form and capital partner agreement. You will then get your credentials, handbook, and any passwords or wire transfer instructions you will need. Then, once you are comfortable analyzing deals for yourself, you can commit to lending and becoming an equity partner on projects. Once in a project, you can just sit back and we'll keep you up to date on its progress, and all you need to do is cash the checks. Welcome to the team. We look forward to years as partners. We hope you've enjoyed our video presentation. Please feel free to reach out with whatever comments or questions you may have. Until we meet again, goodbye.
Thanks for watching. Please take a moment and follow our socials at Little Touches RE. Your referrals are also helpful and genuinely appreciated. Please do us a solid by liking this video and sharing. And, if you want more content like this, subscribe and click on the bell to get notified of new videos. And of course, we always welcome comments below. Thanks again. Now, check out these other videos.